Friday, March 13th, 2020, MONERO 64, home of alternative economics and contrarian views. Today I want to focus on the Dow Gold Ratio, on how the reset has accelerated. I'm going to go over some longer term charts of the Dow Gold Ratio, what it means, and a look at a couple of videos I've made in the past, late last year, about the Dow Gold Ratio. It looked at the time that it would be almost impossible for us to get to the levels that I foresee. But after these last few weeks, you'll probably realize that nothing is impossible. And I would say the Dow Gold Ratio is about cycles. It's about expansion. It's about deflation. It's just like in life. If we don't go to sleep every night and refresh our batteries, it's very difficult to wake up the next day and have a good day to do what you need to do. If you go out at night, for example, to a party, and you party very hard to the early hours, you're going to be very tired. And all I think the Dow Gold Ratio is a long-term economic cycle where the credit sector expands versus real goods, tangible assets versus money. Don't forget, JP Morgan said gold is money, everything else is credit. So all it is a correction of the cycle, and it's a good thing. It looks scary at the moment, but I think it will be the best thing that can happen. Billy and I, before we started the video, we went out for a nice walk this morning. Very few people out there. It's a nice sunny day for a change in England. Still very cold. So we all need our rests, our exercise. And this is what it's all about, in my opinion. A reset, of course, is another word for a correction. And I think the current credit cycle has been correcting since the year 2000. You might think that's weird, but I will show you why. So let's first start with a 200-year chart of the Dow Gold Ratio. So all the Dow Gold Ratio is the amount of ounces you need to buy one Dow. So if the Dow were at 1,000 and the price of gold was at $1,000 as well per troy ounce, that ratio would be 1. This is a long-term chart going back to 1800. You can see how that ratio has actually been rising quite a bit. In the Fiat era, which is pretty much between 1900 and 1920 on that chart, you can see that the credit expansions and the deflations or the corrections have been relatively sharp ever since the Federal Reserve has been created, ever since the world has moved into more of a fiat currency system. So what do the peaks and troughs signify? Well, the top there in 1929, that was when we had the stock market top in 1929, and the credit bubble was at its highest. And then we had the collapse in the stock market, and that ratio dropped to around 2. I think it was a little lower than 2. This chart shows it at 2. And then it took, like many decades for the cycle to inflate again, the credit cycle, as you can see, from the early 30s. And it finally topped somewhere around 1966. I think that ratio got up to around 26 at that time. Back in 1929, in the 20s, it got to just under 20. So you can see there that stocks and the credit cycle topped around that level, and then it took all the way until 1980 for it to reset, to unwind. And I think the ratio got to 1.29 in January of 1980. Gold got up to almost 900, and the Dow was somewhere in the 800s in 1980. And here's the reason why I think we've been resetting since the year 2000. As you can see, from 1980 until 2000, we had a huge credit expansion. Gold didn't do very well either, and that ratio got up to the low 40s. So you needed over 40 ounces of gold to buy one Dow at the beginning of this century. And that's why I think we've been correcting since then, because we topped there. We went to around just below 7 in 2011, that ratio. And as I've said several times in the past, we've had a counter trend rally in the credit cycle. And so that's where we're at. We topped in 2018. So that means the stock market topped in terms of real money, the Dow, in 2018, just above 22 to 1. So you can see what we're doing. I've been speaking about this ratio. We had a head and shoulder formation, as you can see, earlier last year, and we've broken through that. This chart gives the Dow Gold Ratio at around just below 13. This morning, if I take out my Hewlett-Packard calculator, old one, and I look at where the Dow is, the Dow futures at 22,039 divided by 1592. That's where gold is. The Dow Gold Ratio is at 1380. So we topped just above 22 in 2018. So yes, I think we are well on our way to seeing the Dow Gold Ratio revert back towards that one level. And you might think it is impossible, but you've seen what can happen. We've dropped about 27% in the stock market since the top in February. So everything's possible. We've gone from 22 to around 13 and a half, 14 in this ratio. And if you look at the longer term chart again of the Dow Gold Ratio, you can see that in the Fiat era, since the Federal Reserve was created in 1913 and went into operation in 1914, the credit cycles get wilder and wilder. So I would say that we could even see that ratio drop below 1, which would mean that you would need less than an ounce of gold to buy one Dow. So where is the level going to be in terms of the price of gold and the Dow? Difficult to say. It looks to me that it could be towards the low side in terms of the Dow. I'm not sure they're going to be able to inflate the system much longer, even though they will. We saw yesterday the Federal Reserve added another $1.5 trillion into the system, to the repo market. So they're going to keep doing it. ECB announced stimulus. So I listened to an interview this morning, Charles Nenner with Greg Hunter. Charles Nenner has a target of 5,000 for the Dow. And I think he could be right, 5,000. I mean, we've gone from 30,000 almost to basically 20,000 in a matter of weeks. Why can't we go to 5,000? Don't forget the Nikkei in 1989 topped just below 40,000 and dropped almost 90% from the highs. So it's possible. In 1929 as well, the Dow almost dropped 90% from the highs. So I don't think it's outrageous to think we could go back to 5,000. And as Charles Nenner said, back in the 1990s, the Dow was at 5,000. So things were okay in 1990. There is one thing, though, that could mean that this ratio could go a lot lower than 1. And that's if gold comes back into the monetary system in an official role, or if we go back into some kind of gold standard, we could see gold go a lot higher than, for example, 5,000. Let's say 5,000 gold and 5,000 Dow would be a 1-to-1 ratio. So that's still a possibility, I would say. So yeah, I made a video. It's always difficult to remember exactly when, but it was about a month ago when gold was taking off, or beginning of the year when gold had gone to 1610 after that crisis with Iran. And I've been telling people it's going to get more and more volatile, that you need to hold on to your precious metals, your gold and silver, for dear life, and that you should not let these moves put you off or make you liquidate your savings, precious metal savings. And that's the other thing. There is no level really where you should get out, in my opinion, at least for me, because it's savings. So it's like asking, when should I get rid of my savings? And that's how you have to think about gold and silver. And be as it may, though, I just want to quickly look at some technicals for gold. Some of you have been asking me for the technical analysis of gold, how it looks right now. Well, as I said, it's looking really good against the stock market. It's still, we started the year at 1550 versus the dollar. We're now at 1590. So it's the best performing currency out there. You shouldn't be worried about the fluctuations, in my opinion. But let's look at the chart then. So this is a weekly chart going back to 2010, and you can see the volatility here lately, all over the place. But still holding. I've got the Fibonacci retracement analysis. I've got the top in 2011, around 1920, and the bottom in December 2015 at 1,046. I've always spoken about the 1587 level, which is the 61.8% retracement of this move. 61.8%, of course, is the golden mean. It's a really important proportion, not only in nature, but in markets. So cycles, everything. And look at how we're holding that level, 1587. It seems to be really good support. It was a resistance previous to us breaking out on the upside. But things are not perfect in nature or in markets. Yeah, we could go below this 1587, and we did yesterday. We got to 1560. So why is the 1560 holding? Well, probably because the high back in September last year was around 1556, 1560. So that's a key support there in terms of the price of gold versus fiat. For you traders, that might help. For people who save in precious metals, who are stackers, I wouldn't worry about it. I would keep the strategy of dollar cost averaging, trying to exchange my fiat as much as I can over periods of time, every month, every 2 weeks, every quarter, who knows? It depends on the individual. The other thing I would say that Charles Nenner said, and it was very interesting, is that he lives in Holland and he's got a portfolio of real estate properties. And he thinks real estate prices will go down, but he's not going to get rid of it because he doesn't trust any of the banks. So you sell your property, your real estate, and you cash in, right? Where are you going to put that money? Well, and also the process of selling property takes a long time. There's a lot of uncertainty. I would say precious metals, of course, would be a safe place. But Charles Nenner probably already has precious metals. So that's the other thing as well. You need to think about the counterparty risk. And even if prices go down for real estate and you have a portfolio of real estate, you need to think about the risks of leaving all the cash that you would have from selling the real estate with banks. The banks are not looking good right now. So that's the technical picture for gold. So it's 8:10 a.m. London. Let's quickly look at where the markets are this morning. So yesterday was another wild day. The Fed came out, announced $1.5 trillion extra in repo. The market rallied about 1,200 points to like minus 800, and then just dumped. So it didn't convince the market as the Dow actually finished, let's have a look, 2,352 points. So it looked like it didn't work. But this morning, things have changed a little bit. The stock market has rebounded a little bit. We're up 3.7%, about 800 points. Dow futures at 21,925. S&P 500 is up 4% or 101 points at 2574. Gold is up 11 at 1587. The low has actually been 1551 overnight, and the high 1595. Silver, I wouldn't worry about it either. Silver will outperform gold. I think yeah, you need to hold on to your physical silver. It's going to do even better than gold in terms of percentage. We are above 100 in the gold-silver ratio, but things are a bit wacky right now, so it's not surprising. Silver right now is 1568, down just under 1%. The currencies, sterling got hit hard yesterday. We got below 125, I think. Right now we're at 125.95, up 0.2%. Euro is unchanged, 111.80. Dollar is a bit stronger versus the yen, up 1.25% at 105.90. Dollar is a little lower versus the yuan, just above 7. WTI crude is up 3.88% at 33.18. Bond market, the 10-year yield is up 7 basis points at 92.5. And interesting that the 30-year yield, the T-bond, is up 33 basis points. They had an auction yesterday of 30-year paper, and it didn't go very well. And I think it's one of the reasons the Fed has come out with all the support for the repo market. There's trouble in the Treasury market. Does it mean Treasuries are going to go down in price and yields are going to keep rising? Maybe a bit, but I think in the end of the day, the Fed is going to do even more intervention. And I think government bond prices are going to keep going higher. Gold is going to keep going higher. And I don't think the stock markets are out of the woods. No way. There's still a long way to go. Listen to the Charles Nenner interview on Greg Hunter's channel. So the reset is accelerating. And by a reset, of course, I mean a correction of the credit cycle. A correction away from debt, paper assets, into real goods. And gold is the ultimate measure of real goods, of money, of tangible assets. And we're still, in my opinion, a long way from completing this reset, even though, of course, it's accelerating. When it will happen, maybe in the next 18 months to 2.5 years, I'm not sure. But we know which way the direction is going. If you enjoyed this video, please hit the like button, share it far and wide. If you haven't subscribed to the channel yet, think about subscribing. You can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you all a great day. Take care. Bye.